You've been on a retirement extension for 5 years. Every month, 80,000 baht lands in your Bangkok bank account. Your UK pension, your savings, money you already paid tax on back home. Here's what changed. Since January 2024, the Thai Revenue Department now considers that remitted money potentially assessable income in Thailand. You may owe tax. You almost certainly need a TIN. And right now, you probably don't have one. Here's the scale of the problem. The Revenue Department estimates there are over 300,000 long-stay foreigners in Thailand. Fewer than 30,000 of them have a Thai tax identification number. That means roughly 270,000 expats, people who may legally owe Thai income tax under rules that took effect on the 1st of January 2024, literally cannot file a return. They cannot claim deductions. They cannot access double tax agreement protections that might reduce their liability to zero. And they are sitting on a potential penalty of 200% of any unpaid tax, plus 1.5% monthly interest compounding. 200% surcharge. On one side of the ledger, 0 baht to get compliant. On the other. The math on this one is not complicated. This video is the complete step-by-step guide to getting your Thai TIN in a single afternoon and understanding exactly what it unlocks. Let's put real numbers on this. Go back to that retirement scenario. 80,000 baht a month remitted from the UK. That's 960,000 baht per year, roughly $26,000 at current rates. Under Thailand's standard personal income tax brackets and before any deductions, that income could generate a Thai tax liability somewhere in the range of 60,000 to 100,000 baht per year, depending on your specific circumstances and what treaty protections apply to you. Now here is what most expats don't realize. Thailand's deduction system is genuinely generous. By the time you stack your personal allowance, your age-based deduction if you're over 65, and your 50% earned income deduction capped at 100,000 baht, a significant portion of that 960,000 baht may drop below the taxable threshold entirely. But you cannot access any of those deductions without filing, and you cannot file without a TIN. That is the core stakes of this video. The TIN is not the tax itself. It is the key that unlocks your ability to manage the tax, legally, accurately, and on your terms. Let's establish exactly what happened and why the TIN went from optional to effectively mandatory overnight. For decades, Thailand's tax rules contained what's sometimes called the prior year loophole. Foreign income was only assessable in Thailand if you remitted it in the same calendar year you earned it. Transfer this year's earnings next year, and technically, they weren't Thai assessable income. Many long-stay expats structured their remittances accordingly. On the 1st of January 2024, Revenue Department orders POR 161 and POR 162 permanently abolished that loophole. The rule is now simple. If you spend 180 days or more in Thailand in a calendar year, you are a Thai tax resident, and any foreign source income you remit to Thailand from that point onward is assessable income in the year you transfer it. The year you earned it is no longer the relevant question. 180 days. That's the number. 6 months. If you cross it, the rules apply to you. And for retirees, DTV holders, and most long-stay expats, you're crossing it every year, almost by definition. So let's get into the actual process. Here is exactly how you obtain your Thai tax identification number. First, understand what you're getting. A Thai TIN is a 13-digit unique identifier issued by the Revenue Department, in Thai, the Krom Sapakon. Not by immigration, not by the Labour Department. Not derived from your passport number, your work permit, or your pink ID card. It is an entirely separate document, and that distinction confuses most first-time applicants. Second, the application is in person. As of 2025, there is no fully operational online TIN registration system for foreign individuals in Thailand. You must go in person to the specific Revenue Department area office that has jurisdiction over your registered residential district. Your district, not any convenient office. Bangkok alone has more than 30 district-level branches, each covering defined postcode zones. Outside Bangkok, you'll be looking for your provincial Revenue Department office. To find your correct office, go to rd.go.th, the Revenue Department's official website, and use the branch locator. You want the office covering your registered address in Thailand, not your visa address, not your hotel. The address on your rental contract or your TM30 registration is the one that determines your branch. Third, the documents. You need 3 things. Your original passport with a valid visa or entry stamp showing your current stay, a copy of your passport's photo page and visa page, and proof of your address in Thailand, a rental contract, a utility bill in your name, or a TM30 receipt from immigration showing your registered address. The application form itself is free at the office or downloadable from rd.go.th. You fill it in, you hand over your documents, and, when everything is in order, you receive your printed TIN certificate or taxpayer card before you leave the building. Same day, one afternoon, 0 baht. That's the process. There is no complexity hidden in it. The only barrier is showing up to the right office with the right documents. Now, what does your TIN actually unlock, and what should you do with it the moment you walk out? The first thing, your TIN allows you to file a Thai personal income tax return. The filing window runs from January through March for the prior tax year. So, for your 2024 income, the filing deadline was March 2025. If you missed that, the filing for 2025 income opens in January 2026. Getting your TIN now means you are positioned for the next cycle. The second thing your TIN unlocks is double tax agreement access. Thailand has active DTAs with over 60 countries, including the UK, the US, Australia, Germany, and most of the EU. These treaties can reduce or eliminate your Thai tax liability on specific categories of income. But here's the critical point. You can only invoke DTA protection in a filed return. Without a TIN, you cannot file. Without filing, the treaty protections exist on paper, but do nothing for you in practice. The third thing, having a TIN and a filed return creates a compliance record. This matters more than most expats currently appreciate. Thai Immigration and Revenue Department data sharing is expanding. The evidence that you've engaged with the system, that you filed, that you claimed your deductions, that you applied for treaty relief where it applies, is documentation worth having. And for many retirees, after you run the full deduction stack, the personal allowance, the 65+ allowance, the earned income deduction, the actual tax liability comes out at 0 baht. But a 0 baht liability filed is a very different position from a non-filing that the Revenue Department has to interpret. Here is the one thing to take away from this video. The Thai TIN costs 0 baht and takes 1 afternoon. The penalty for non-compliance runs to 200% of unpaid tax, plus compounding monthly interest. The gap between those two outcomes is entirely in your control. You do not need a lawyer to get your TIN. You do not need a tax consultant to walk in the door of the Revenue Department. You need your passport, your address proof, and your nearest branch from rd.go.th. Get the TIN first. Then understand what you actually owe. Because for many people on this channel, after deductions and treaty protections, the honest answer is 0. But you cannot know that without engaging with the system. And you cannot engage with the system without the 13-digit number that starts the whole process. For the full POR.161 remittance guide, the DTA breakdown by country, and the deduction stack explained step by step, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com or subscribe to this channel so you don't miss what comes next.